Very strong set of results that came through. You've had quite a strong number when it comes to the retail turnover growth, and that was up around 16% or so. Take us over the period that was, because we've also seen the realization of a lot of acquisitions as well.
Yes. So I think the key metrics, we 43% distribution per linked unit. That's 12.7% up on previous comparable period, which is double the sector average, which is quite commendable. We also up on our value, portfolio value of about 3.78 billion, which literally translates to NAV per linked unit of about 10.53 rand. If you compare that to our share price of about, I think at the time we closed at 970 on the reporting period. Our share price is at a massive discount to the NAV per linked unit. And our gearing is down 37.9% as well. So those are really the key metrics. Our debt remains fixed at 80% with an average term of about 3.5 years. You spoke about the turnover growth. We've seen exceptional good performance on our retail portfolio. Hemingway's Mall on the 6th month to end of February on the reporting period at 17%, Bloot Street about 18%, and Dunsane about 13%, which is quite exceptional, and it's well above market average in terms of national retail sales and comparable centres.
Well, let's take a look at your overall portfolio. I mean, you're sitting 60% retail.
Yes.
You've got 40% office.
Yes.
So obviously retail doing very well. Let's just delve into the retail space and tell us about tenant failures. Have you seen anything of that kind over the period? And if so, obviously your turnaround time must be very good given the fact that we've actually seen such strong turnover growth that was driven by the retail space.
Yes. Look, if you look at our portfolio as of today, we're about 2.6% vacancy, which is quite very good compared to the sector average, well below half of sector average.
Are you talking as a whole or just within the retail space?
In the retail space.
Okay.
So if you look at the performance of the centres, it's actually a good sign for your stability of your tenants. So we've had very little tenant failures. Actually, a handful. I think we've had about 3 or 4 tenant failures, which we've replaced. There's about 1 or 2 that are in the process of replacing. In fact, our vacancy in the next quarter with the firm negotiations that our team is busy with should come down to about 0.5, which will be highly commendable.
Estimated rental values, how is that changing? Are you seeing an uptick there or?
Yeah, we've had some. I think on average we've had positive reversions on our renewals because the centres are performing very well, so which is quite good. I think we've got very good properties there.
With regards to your office space, I mean, as I mentioned, 40% of your portfolio in the office space, but you're saying that you've got very strong tenants and you're also in very lucrative spaces with regards to where you see yourselves in the likes of the Eastern Cape and also in Gauteng.
Yeah.
So just tell us about office space, because we keep hearing bad news there that vacancies there are much higher and it's just far more difficult to realise the rentals as opposed to what you see within the retail space.
Look, I think our philosophy has always been to stick with good profile A-grade or A-type tenants. We have government in 38% of our office portfolio, and that's really a very defensive portfolio with long-term leases. So we're not really exposed to what the sector is seeing in terms of insolvencies and downsizing and so on and so on. So we literally our portfolio is insulated from that because our strategy was always to actually pick properties that have defensive characters, and that's really played well for us in this period.
What has your experience been with regards to electricity tariffs and also just a far more expensive scenario to do business? Are you passing this on to your tenants?
Look, it's unfortunate because you've got to pass it on as a landlord. But we engage in energy efficiency drives, which we work together with our tenants in order to reduce their consumption. And I think if you talk about shopping centres, for instance, you have to embark on very rigorous energy management practices. For instance, 60% of your power is taken by air conditioning, and you've got peak times when the centres are heavy with volumes of people, and when they're not that heavy, you can cut off the power and reduce your air conditioning consumption. So it's something that you've got to keep on working on, and to reduce the cost. With the electricity tariffs that's gone up, our objective has always been to keep the end price or the end cost to our customer the same, and we've achieved that.
4 acquisitions over the period.
Yeah.
Tell us about when we will see an impact on the overall earnings. I think most of them are only going to come to effect, I think, from the 1st of July, so still some time to go. Tell us about that.
Yeah, so I think in the next reporting period, there'll be over July and August, so it'll be only 2 months impact. But the real swing happens in the following period, which is 2013 year end. So we're very excited about that. We've got 4 properties. We started off with about 6 properties, but following a due diligence, we've got 4 properties that fit our criteria that we're very happy to proceed with. We've got funding approved for it, and we'll be raising capital in the market in the next 3 weeks.
Competition is heating up within the property space, the listed property space.
Yes.
I already can see a smile coming through. Are you talking about your share price trading at a discount relative to NAV?
Yeah.
Hermans and Roman going to be listed very soon. What is your sense on all the competition that's coming to the fore? Do you view this as a threat? Do you think that it's actually a good development?
Well, I think it's a good thing for the market. It gives the investor options, gives the investor wide choice of different counters instead of a few counters that monopolize the market. So I think it's a good thing for the market, and especially because each entrant's got something different to offer in the market. And I think we're yet to see a repricing in our portfolio. I think we've been new guys, had to deliver, and I think we're well on our way to do that.
Sisa, I mean, with regards to acquisitions down the line this year, would you be looking at any African shopping centres, retail space?
Yeah, we're quite active. As you know, Rebosis has a first right of refusal to the Billion Group portfolio. And part of the pipeline for Billion Group is in 4 different countries: Angola, Mozambique, Ghana, and Nigeria, with about 8 different centres that are in their pipeline. So, Rebosis has the first right of refusal on those centres. So in terms of growth going forward, certainly we will not be short of options.